To introduce Nichole McCulloch, Managing Partner at Stratum, who will be moderating. And Nichole, if you'd like to introduce your panellists.
Good morning, everyone. I hope you're all well. So we're going to be doing how juniors can capitalize on the supply crunch, creating elevated demand. I'm sure most of the panelists, everyone in here will already know. But I'd like to welcome David Street, who's the co-founder and CEO of Tembo Capital. Alison Turner, who's the portfolio advisor for Umbono Global Mining Fund. Bert, Koth, who's the portfolio manager for Denham Capital, and Pim, who's the portfolio manager for Hawke's Point Capital. So if you guys can join us on the stage, that would be great. Thank you. Right, so we've got a really, really interesting and topical panel this morning. So the way that we're going to do this is we've got questions for all of our panelists, but I'd like this to be quite interactive with the audience as we go. So if you have questions, please ask in time as opposed to holding them for the end, if that works for everybody here. So David, I think we're going to start off with you this morning. Is your mic working?
Yeah, is that working?
Working? Good. Great.
Thank you.
So David, how has the financing journey for juniors changed, and why are the players and processes different in this bull cycle?
I think it's changed a huge amount. I mean, I started my career in a bank in Rothschilds, got a long time ago, about 30 years ago, and in those days, it was very much if a junior company was developing a project, it was equity, debt, pretty much that was it. Maybe some mezzanine of some type. Fast forward to today, I mean, you've got a whole subset of streaming companies, royalty companies who take a direct interest in revenue from projects directly. You've got debt providers who are somewhat different to the debt providers back in those days. There's a lot of funds who can, put together a debt package on their own often, rather than some kind of syndicate of lenders. You've got quite a lot of end users, off-takers in the last sort of few years, OEMs, GM, Stellantis, people like this, and people like CATL in the battery space, who are directly investing initially through off-take, but now directly in equity in projects. And I think that's a big change over the last sort of 3 or 4 years probably. And I guess the challenge for small companies is how do you navigate your path through all of those sort of financing sources? When do you bring them on in the right order? How do you fit them all together? What are the intercreditor issues between all of them? And I think the sort of regular equity sort of piece of the jigsaw is probably one of the harder pieces to fill these days relative to, particularly in the current market. And I guess that's the sort of thing we look to provide for small companies, strategic equity sort of positions, really. But I think there's a lot of players providing the other types of capital, probably not so much straight equity in the current market. There's some exceptions depending on commodity, etc.
Well, I see some head nods from the rest of the panelists. I mean, would you agree with that, or would you have any sort of alternative views on that?
No, I think the only thing that I would add is that probably the equity portion of the development financing is for most companies still very difficult to raise. So I think that has, if anything, we think that's actually become more difficult. So what we see actually is that the earlier stage de-risking capital is actually quite readily forthcoming from the public markets. But when it actually comes to development financing, that is actually in most cases not forthcoming, or the public markets. But I guess that's the purpose of funds like us, to actually step into that financing need.
Yeah. Great. Well, we're going to move on to Alison this morning. Alison, so you're a little bit different than some of our other panel members. So you're a hedge fund, right? So what role do you think London plays now with investment strategies becoming cautious over stock-specific risk? And do you think liquidity is coming back in mining, and in what form?
So I think London still represents a deep pool of capital, and that's both on the institutional side as well as private wealth. I think the capital is there, and indeed, the appetite to take risk is there. But there seems to be a bit of a disconnect in some of the traditional equity markets where that risk capital is struggling to find its way to those investments. Fund managers are quite often concerned about liquidity. They are concerned about taking stock-specific risk at early stage in companies that have quite a binary outcome as to whether they may be successful or not, and what reputational risk does that then, confer onto the fund manager if that goes wrong, and who comes asking questions. So I think to some extent, the kind of risk that people are feel that they're able to take has been dampened down. But the capital is still there. And I think you're seeing elsewhere in the world now in kind of slightly late cycle, a lot of M&A happening and quite a lot more excitement in the junior mining sector. And I think we'll see, London to some extent follow that as well. Investors do tend to be quite momentum following. And when things are hot, then they pile in. So I think some of that liquidity will probably come back.
And you mentioned different jurisdictions. Are there specific jurisdictions that you feel are coming back in that and or in particular regions?
I think from what we're seeing, the Australian market is quite mixed. It's found specific subsectors that have kind of been darlings and had really strong runs. And then, in other areas, the liquidity has been problematic and probably the same actually in Canada. The US has not traditionally embraced mining in a huge way. And I think that's still the case. There's quite a lot of more interest in the sort of downstream processing side.
Great. Pim, do you have any comments or follow-up thoughts on that?
Maybe to the last point of your question on the generalist, I wouldn't say the generalists have trickled down, in my observation, yet to embracing juniors. So I'm not sure whether we were going to see that or what the catalyst or trigger is for that, but that's certainly one observation that I would make. I think London has got the benefit of having a lot of people that understand mining and mining finance. But the market itself, if I compare it with when I started my career, in the early 2000s, there were many mining companies listed in London. And I think, and again, I don't know what the catalyst is to change this, but my observation would be there's much less so. And the few that have ventured and tried haven't, helped London raise its profile because they, not all of them, but a couple of them have been unsuccessful, and that hasn't gone unnoticed. So London is becoming, as a stock market, more de minimis as compared to a Toronto or an Australia. But definitely as a knowledge base and a source of capital, it's still there.
David, any thoughts at the end there?
I think that's right. I mean, there just isn't the same pool of capital for very junior companies in the UK. There is a significant pool of capital for gold companies, for example, in Switzerland for very early stage gold companies. But it's never, the AIM market's never really kind of taken off for mining. And as Pim says, although there is a lot of infrastructure around mining and a lot of funds here, they can invest in Australian companies, in Canadian companies. I mean, they're not most of our investments. I think only one or two have been listed in the UK.
And Bert?
Yeah, just a general observation, less about London, but in general about capital availability in metals and mining. So you have a lot of very successful companies that have, like, say, 30, 40 years life of mine, and they're trading at 4 or 5 times EBITDA multiples, right? So that does not make a lot of sense if you compare that, for example, to some technology companies that got barely any revenue, right? And they're trading whatever at like 50, 80. I mean, so I think the reason for that is that probably the generalist investor pool that is willing to mobilize real liquidity into mining stocks, not just junior mining, but even producing mining stocks, right, is probably relatively low, right? And it's actually probably mostly hedge funds that actually trade in mining stocks. So as a result of that, you actually have this situation where actually companies that are very successful, right, and even those that have, in some cases, like 30, 40 years life of mine, trade at actually really low multiples.
Yeah, let me maybe touch on that, because I do think we need to do a better job as an industry promoting ourselves, but there is a few characteristics that make us very different from technology. So yes, we have, as an industry, we're absolutely unique in that we have an ability to see massive margin expansion if a commodity price is booming. But one thing that technology has that we don't, and we haven't found a good answer for it, is we don't have moats. And even though your revenue is low, if as a technology company you're able to somehow ring fence a technology, then you can put a massive moat around it and you become the next Amazon, and the sky is the limit. And that's the challenge with mining, and with mining finding a good answer to investors as to why our industry is so exciting. And I think we've all proven that there is a lot of value to be created by a lot of companies, but we have to show that that is done through rigorous technical work and proving up a deposit and going through the various steps of development. It's not going to come from us finding a unique technology that's going to create this moat, that's going to create the monopoly. And as long as that's kind of the trade-off, we need to become much better at articulating why a generalist would want to invest in the industry. We all understand it, but we've done a very poor job in explaining why others should also want some, especially in today's date when we're going through this whole EV transition.
Just a reminder to everyone, you can ask questions at any time. So if you have a question for the panelists, there we go. All right.
Yeah, could I? Jeremy Dowler from the DF Mining Fund. None of you mentioned major companies. I've noted that I've noticed that Rio. Hang on, is it on? No. I've noticed that Rio Tinto have invested recently in one or two companies. I've noticed that certain Anglo, I believe, are sort of investing. I mean, these companies are churning out billions and billions and billions a year, and they are investing. They are definitely going in. Maybe they're going for 9.9%. They can help a lot in the equity space, and I believe we'll see more of that as the gold price goes up to 2,200 plus. If it does, there's going to be so much cash coming out that even mid-tier companies will be financing smaller juniors. I think that's where it might go.
Alison, do you have any thoughts on that?
I mean, I think that observation is perhaps correct, but I think it's to the very early stage of that. I think, in fact, in contrast to previous cycles, the major mining companies have been remarkably absent. They've been doing very little M&A. The M&A that they have been doing has been, and I maybe put gold to one side here, but certainly in the base metals, the M&A and specialty minerals even less so. The M&A that they have been doing has been concentrated primarily on producing assets and not on major development projects. So if you have a project that needs $1 billion to develop, the majors just haven't been stepping in to grab those projects. And I think that's hugely difficult for companies, because those are exactly the kind of projects where you're often looking for a major as a partner. So I think, those kind of little like grass shoots of the majors actually saying, okay, maybe we need to be stepping out again are very kind of early, in that process. We're certainly not sort of seeing that boom of kind of investment from the majors that we perhaps saw in previous cycles.
And there's also another aspect here. And again, in a previous life at BHP Billiton, I actually managed some JVs with junior mining companies that BHP had. For a junior mining company, that's actually a big decision to take a larger mining company on the books as a shareholder, because in many cases you actually lose option value for the future. Because typically this is not just a passive small minority position, right? This is a major actually coming in and having rights of first refusal on this, rights of first refusal on there. So actually you give a lot of option value for the future away if you actually have a major mining company as a shareholder on your books, typically, right? And that might not be good for the remaining shareholders.
Pim?
Yeah, no, I would echo that. Like Bert, in a previous life, I ran a venture fund with exactly that mandate for Xstrata, and we ran in exactly the same set of challenges to convince a company. And I would also say that you're taking an entity that typically operates at a certain kind of oil tanker speed. And what you really need is kind of speedboat decision making, and that's not really what they're well equipped to do. If you have to go through various committees to make a decision to sign an NDA, let alone match your stake and so such, I found it quite a challenging set of circumstances to operate in. So I think there is space for it, but I'm not fully bought into it being the be-all and end-all. I think it's just one other leg in all of the others that we discussed. And you're right in pointing out that this is an important leg, but I don't think it's about to take over in any way over and above what it's already doing.
And David, would you agree that the speed of decision making is problematic when working with the majors?
Yeah, I mean, they're just very different styles of companies, aren't they? And, frankly, there was such a misallocation of capital by the major companies the last time around, and some of their shareholders and the very big funds are still, I think, actively putting them off transformative, or very large M&A projects with very large capital expenditure tickets. You see that occasionally, more so in gold, which is much more fragmented industry, and I think you can make a good case for, gold companies merging together. I think that has happened, and I think will continue to happen. But I don't think your shareholders of a BHP or a Rio. I don't think they're looking for them to buy some monster development project, and they have a lot of these projects in their own portfolios. They don't get a lot of value for as it is.
Great. Does that answer your question? Great. Perfect. Good. So Pim, just moving on. So we have another question.
Thanks, Mike Colligan from Blue Lakes Advisors. I've been involved in a couple of projects recently where there's been significant local finance provided. There's a couple situations. Colombia, for example, has got a very large amount of pension money, which needs to be invested domestically. And so some of that can be vectored towards the mining sector because there's needs for capital there. In addition, various places in Africa, some of the banks are becoming a good deal more aggressive. So would you care to comment on non-London, non-traditional sources of capital for the junior mining industry?
David, do you want to tackle that first?
Yeah, I mean, I think it's sort of horses for courses, isn't it? Depending on which country you're in, and there are different financing institutions in different places, and as you say, some captive pools of capital in Latin America, for example, with pension fund capital, which is very domestically focused. I would say, I think the other interesting thing that has happened is there is in the current geopolitical environment, there is a sort of big push from governments to incentivize projects through grants, subsidies, et cetera, and you're seeing this obviously in the US with the Inflation Reduction Act, and in Canada, in Australia, in other places. I think it is very challenging for small companies to finance these projects, and it's important to have the right people in those companies to assess the types of sort of grants or local funding that is available increasingly.
Any other further comments on that from the panel?
Yeah, it's a well-trodden path. Quebec springs to mind as a particular good example of a state that's really supportive of its local industry, and all the initiatives that David mentioned, I think, go to show that there is a lot of movement. I think for those projects, we almost remove the capital bottlenecks for now, and then we hit another very, very stubborn one in the form of permitting. And what I would like to see much more of, as opposed to more capital, because I don't think capital is necessarily the bottleneck, but I'll get to that. But I think rather than asking for more grants or for more local funding, often with these projects, what I'd love to see is a clearer path to permitting, particularly in the jurisdictions that are maybe a bit less traditional to mining, that now want to have their own source of raw materials. Because it's my belief that once we show a good path to permitting, the capital will follow. And that if people draw up a whole list of the risks, they start with the geological risks and they somehow get their minds around it, and then it's permitting risk and developing and construction risk. It's the next rung on that ladder, the permitting risk, that people really scratch their heads on and then run away with the capital somewhere else. So I think the capital as such could be brought to bear for those projects, but it's the important hurdle of getting our heads around permitting and how a project can be permitted that prevents people from investing. I don't think that's necessarily the case that the locals need to come to bear and then it will be fine. Where I think the locals can help us most is creating a clear path to permitting.
Great, thank you. Any other questions before we move on? No? Good. So actually, Pim, just following on with you, actually, do you think deals are available despite high inflation? And who's providing risk capital to early stage?
Yeah, I think we touched on a lot of those points already. I would go back to my statement just now on we'd look at the variety of the risks. I can price in inflation. I think I can price in construction risk with the right team and management risk. I think we have a good handle on geological risk and upside, and that's kind of our bread and butter. And with all of that, we can come to a view which are the projects that we'd like to invest in and not. So capital is definitely available, but we need to have an ability to evaluate many of those risks, and a lot of the projects would be assisted materially if the politicians could show us a clearer pathway on some of those items, as opposed to some of the statements that we're currently hearing.
David?
Yeah, no, I think Pim sums it up well, and there is a disconnect, I think, between money sort of being handed down by governments and to projects that won't get permitted, frankly. But I think we're in an inflationary period. Interest rates probably, my personal opinion, likely stay higher for longer. Cost of capital has gone up, over the last couple of years. Inflationary environment, more difficult to build projects as well in that kind of environment. So.
Having said that, the inflation is also, there's one positive aspect here as well, because typically in the inflationary cycle, and we analyze the metal prices, the profit margins of operating costs over several historic inflationary cycles. So you can make the argument that a producing mining asset, once it's up and running, is actually a pretty powerful inflation hedge in the investor's portfolio, right? That is not true for development assets. An early stage asset. That's true for producing assets, right? But I think because typically what you have is that the metal prices significantly overshoot the operating costs increases in the inflationary cycle. So if you're confident, as Pim said, right, that you actually can handle the construction risk, right, and you can price in the inflation into the development capital, right, you can actually generate a pretty powerful inflation hedge for investors. So there's also a positive element about the inflation story as it comes to mining.
And actually, it's Bert, just following up from the question about sort of government involvement in this. I mean, do you think government mandated capital helps plug finance gaps? And are there wider tax incentives a catalyst for mining activity more broadly?
It definitely does. And to be more specific, so especially if you look at the energy transition metals today, right? You have the deposit that you need, obviously, but then there's a very complicated downstream associated with that, right? And I at least would argue, others might disagree, that the job of a mining investor is not to build a lithium hydroxide plant or a rare separation plant or a battery manganese refinery. These are very, very complicated specialty chemicals disciplines that are actually just not in the comfort zone of typical mining investors, right? So I think it's there where I think government initiatives need to kick in to create the necessary downstream, for example, in OECD countries, right? That is required, right? Because mining investors can handle the mining upstream risk. I'm perfectly comfortable on that. So I think on that one, you don't need kind of money from the government. You need a pathway to permitting, as Pim just said, but you don't need money from the government. Where you might need money from the government is actually to enable the downstream, because the execution risk is just, frankly speaking, alien to most metals and mining investors.
Any other comments from the panel on that topic?
The only thing I would say is that what we are seeing at the moment is quite an interesting development where governments are incentivizing very local production. So they're not just incentivizing an alternative value chain, which arguably goes from the best deposit in the world that might be in, East Africa, into a plant in Europe. They're really trying quite hard to incentivize the whole value chain to be in their country. And in certain cases, that means that not the best deposits actually are the ones that kind of get moved forward. So I'm not quite sure what that means for investors. I think it's just something to be aware of.
Back over there.
Just trying to maybe tie two comments from each of Bert and Pim. Pim, you'd mentioned but mining is different than tech because there are no moats. But But in the current energy transition sort of context, and what Bert said in terms of mining investors, no mining, one of the things that terrifies me as an investor is exactly the sort of high-end specialty chemical plants. It's a very different skill set, but is there not an opportunity here to create the same technology story with moats where, once you do have one of those plants built, all of a sudden you are in a pretty unique position within a given market? And is there room for that kind of a mentality change within the sector?
Yeah, I have actually given that quite a bit of thought, and I think there might be at a very, very small scale. However, the challenge we have is that not every deposit is the same, and even if it were to be, I'm finding it really difficult to see how through, for example, a licensing model, you could actually make money. There's definitely an argument to be made, but I haven't in my mind got the maths to work. If someone fixes DLE for lithium to the point that it's all of a sudden unlocking all the lithium brines, great, but how are they going to really monetize that model? I haven't quite worked it out. I think there is some money to be made, but I don't quite think it's quite in the regions that you would see if you were, a Microsoft or an Amazon. So I think it goes some way, but not all the way. If you then compound that with some of the capital requirements that you need, the dollars, is that really wise for me? Is that me doing the best thing for my shareholders to invest that? Because these are big amounts of capital, and I can't quite see how I can make the same returns on a risk-adjusted basis as compared to investing it in maybe a handful of mining projects, so I'm more diversified, and each of them I can still make maybe 3 to 5 times my money. That sounds to me still like a better bet, but maybe someone with a different agenda and deeper pockets and more understanding of technological risk can make that work. But yeah, the fact that there isn't a good licensing model to extract true value if you were to be successful, I think stands in the way of that model working. But I'm still developing my thoughts. I love to continue to debate, but this is where I'm standing today.
And the other thing is, take a look how equity has performed, where it actually assumed the risk of financing complicated processing in metals and mining, right? You just have to look at the economic graveyard of all the kind of laterite nickel projects, right, that are out there, right? You just have to see the first heavy rare separation plants that were built with investor capital outside China, what happened there, right? The number of refractory gold projects that lie on the economic graveyard, right? So the mining, so there is unfortunately history that when mining investors pour actually money into complicated processing, that very, very often it ends up in a lot of tears as well. So it's just the mining investor today doesn't have the skill set to put money into complicated processing. I don't think that's our job.
Great. So yep. Will?
Question for the panel. We haven't mentioned EV automakers around here and the necessity to invest as a sort of an existential crisis. So if you look at auto manufacturers, and even let's pull Middle Eastern sovereign wealth funds in here, do you see the risk profile of mining investing changing out of necessity when these guys get involved in order to remain relevant?
David?
Yeah, I think it is an interesting development. A few years ago, those sorts of players felt that they could source enough raw material just through doing offtake type deals, and that's clearly not where they sit today. If you go to a mining conference today, there'll be a whole host of people from OEM companies, and they're looking to invest quite significant amounts of dollars. And I think back to the earlier question, that is an area where, just in terms of deployment at that kind of scale with Middle Eastern governments, OEMs, maybe that is a sort of pairing or consortium that looks to unlock some kind of major, transformation in more of a technology processing type arena, just in terms of the scale of material that they need for their processes.
Oh, sorry.
My bigger first of all, I totally agree with David's statement, but my bigger concern is actually that when you have new types of investors enter the room who don't really understand the sector, that they're actually prone to significant misallocation of capital, right? Because obviously when an OEM enters the room today, right, I mean, they get all the beautiful presentations and everything and the slides, right? So I think the temptation is going to be very strong for some of these parties to actually invest in projects that are ultimately going to fail because they didn't understand the technical risks in the first place. That is actually my biggest concern, that it's out of naivety and lack of actually sector knowledge that will actually see a lot of misallocation of capital by these new kind of strategic investors in the room, which is actually going to destroy the necessary capital formation further down the track.
Alison, do you have anything to add to that?
No, I mean, I would just agree with that. I think that echoes my point about the kinds of projects that are actually seem to be advancing versus the kinds of projects that are perhaps higher quality that aren't advancing.
Right, so we're just winding down the panel now. So we're going to finish with bull bear. So we're going to start down with David. What would you say you're bullish or bearish on commodity-wise at the minute?
Well, I think everyone's bullish about copper in the long term. We're, I would say, pretty bullish on gold given the inflationary environment currently, and we have for quite a long time been quite bullish on uranium, given energy transition, sort of renaissance of nuclear, smaller scale nuclear power plants, etc. We think that probably has further to run. We hope. Those would be the positive things, I think.
Okay. Pim?
Yeah, it's going to be somewhat unoriginal, but yeah, I don't have the capabilities of understanding which battery technology is going to triumph, but they all need to go over the same copper cable. So yeah, copper does seem to be a comfortable place to be and to be insulated from those risks. You might not call it right, but chances are you kind of call it good enough. And gold for the same reasons is something we have in the portfolio and very happy with. So I would add that to the list for sure.
Alison?
So we're bullish on platinum. We think that people have underestimated the shift from palladium into platinum and then the supply side risks in South Africa. And I will go against the other two guys by saying that we're pretty bearish on the short-term outlook for copper. So one copper bear.
And Bert.
And I probably give the most boring answer on this panel because I say we actually don't make calls on the outlook of commodities because we finance the development of mines, and by the time the stuff is in production, we'll have been through 2 further cycles. So for us, as long as it's low cost, long life, and scale, it's good, and we don't really care what commodity is going to do in the next 12 to 18 months.
Thank you for that. We've got time for maybe one more question. Right.
Just like a follow on from there. Where in the capital structure, following on from that question, where in the capital structure do you see value? Equity, convertibles, high yields, royalties, across the whole spectrum. Generally speaking, where do you see value?
Pim?
Oh yeah, I think the way we look at it is on a fundamental basis, not too dissimilar to how Bert looks at it or stipulated he looks at it. We see value in taking on the project and helping it de-risk it through the development phases, and getting the project to trade close to its net asset value by the time it's in production, and then the commodity price will be what it is, and that can either double your potential return or halve it. But that curve is still a very steep one and a highly attractive one. I believe that's best played through firm alignment with existing and new shareholders as well as with management. And that, in my language, means equity is the best way of aligning yourself alongside others.
Great, David. Do you want to add anything to finish?
Yeah, no, I think we have a very similar view to Pim on that. We look to be aligned with management teams. We're looking for equity style returns, and we want to be aligned with the people running the company. So typically we're looking to take a strategic stake. We're not looking to buy the whole company. We look to take 9%, 19% of companies and work, proactively with management to add value to the projects. So typically we're investing in equity. We're investing in convertibles. We actively try and find, because some of the companies we invest in are quite small. So we actively try and find ways not to overwhelm the share register and put off management or other investors from investing. We don't want to necessarily be the only people putting money into projects. So we want to be very much aligned with equity holders.
Right. Well, we are unfortunately out of time. But if you can just join me in thanking them for their time this afternoon.